Hi everyone, Jeff Yasteen here. Make sure to hit our YouTube subscribe button. Follow me on Twitter and on Facebook. Well, last week I told you about a drone stock I like, Kratos Defense and Security. Like all stocks, there's risk involved, but if you like the idea of investing in what I call the emerging drone economy, you should check it out. Now, I wasn't going to revisit the subject of the drone economy so soon, but I have to tell you about an opportunity that the market gods have thrown in our lap. That opportunity is Raytheon Technologies. The symbol is RTX. I think the stock can rise 50% over the next 2 years. So what does this company have to do with drones? Well, plenty, and it will only get bigger in the future. And the reason why I want to talk about the stock today is because it's down. It's been down for the last number of months. And it's a great play on the future of drones and the drone economy. So more on that in a minute. And it's not the only reason to look at the stock, by the way. Raytheon Technologies is the result of a recently completed merger between the aerospace and defense contractor of the same name and another huge aerospace firm, United Technologies. Now, before the merger, Raytheon was perhaps best known for the advanced technology that allowed it to develop and manufacture the famous Patriot missile defense system. United is best known for building Pratt & Whitney jet engines. The two companies announced their merger deal last year, obviously before the pandemic. As you already know, since then, pretty much anything related to flight, making planes, jet engines, guidance systems, you name it, has gotten a thumbs down from investors. Yesterday, Raytheon was dealt another minor blow. It's being kicked out of the Dow Jones Industrial Average. Now, I don't view it as a big deal. If anything, it shows just how out of favor aerospace companies have become, even those with rising revenue and historically steady, consistent profits for years, and ones like Raytheon that pay a nice dividend as well. So here's where drones enter the picture. As we all know, the biggest use for drones, or anticipated use, is for deliveries to our homes and businesses. UPS already uses a drone to deliver blood tests and medicines around the campus of a North Carolina hospital. You've seen the videos of Google and Amazon, which have been testing drones in one form or another for the last number of years. But there's a missing piece of technology to complete this picture. Let's call it an air traffic control network for drones. So think about this for a moment. Before commercial jet travel could really take off in the 1960s, what did we need? Large-scale radar systems to track and monitor hundreds of aircraft at a time, and the technology and protocols in place to keep all those planes from running into each other, to fly safely and routinely. So we're going to need something similar if the drone economy is really going to take off as well, with that routine and safe use of these small autonomous aircraft. Now, airport type radar doesn't cut it. The wavelengths are too large. They can't easily see small flying objects flying low to the ground or distinguish between, say, a drone and a bird. So this is where Raytheon comes in. The company's Skylar technology uses a different kind of radar. It's called active electronically scanned arrays to keep an eye on the sky. This kind of radar, it's basically a flat panel hooked up to a computer. It's not the rotating dish, so to speak, that we're used to seeing in the movies. And this kind of radar can easily distinguish between things like birds and drones. And it can track all of those things to see where they're coming from and where they're going to. The military uses a similar active radar technology to keep an eye out for things like hostile drones of the kind that have often been employed by Iran and various terror groups in the Middle East. Better yet, the panels can be mounted on existing cell phone towers or the sides of buildings or just on top of a tripod somewhere, you name it. If you network all of those signals together, it gives you a 3D picture of everything that's flying around in the low altitude airspace just over our cities and our neighborhoods. Now, for the moment, Raytheon is pitching it as a next-gen radar that's more advanced and with lower maintenance costs than the legacy airport radars. But it could also replace the Doppler weather radar technology that we're used to seeing from local TV forecasters. But the company also sees active radar as a key growth opportunity for drones as they come into wider use. In a promotional article published in Aviation Week, a Raytheon vice president said, "We conceive Skylar as an enabling infrastructure for low-level aircraft, in particular drones, to be able to fly safely." Now, the great thing about Raytheon and the stock is that it has plenty of room to fly all on its own as the drone economy takes shape. So Raytheon is on track to earn $2.81 a share this year, rising to $3.83 next year, and still further to $4.96 a share by 2022. Now, investors have long liked the fact that Raytheon has stable, consistent revenue growth thanks to its U.S. and allied defense contractors. And after the merger with United, obviously from building commercial and military aircraft jet engines. So it finished the second quarter with a record backlog of defense projects and $7 billion in cash. But in my opinion, investors have yet to price in the kind of profit growth on Raytheon Technologies stock after it was hammered over fears of the COVID-19 pandemic. For example, investors have been more than happy in past years to pay a price-earnings ratio of up to 18 in order to own the stock, as where these days they're more inclined to assign it a PE level at a much lower valuation level of 15 and below. Now, I don't think that kind of discounted price will last for much longer as we anticipate COVID-19 vaccines coming online in future quarters and worries about the pandemic slowly fading to the background. So if we take Raytheon's expected profits in 2022, that's $4.96 a share, and multiply by its historic PE ratio of 18, well, we get a stock price of about 90. Now, that's a gain of about 50% over the next 18 to 24 months. Now, are there risks? Certainly. We could get a recession that could curtail further air travel growth. Defense budgets could be cut. Vaccines may not work. On the other hand, we can also make a case that many of those fears are already well reflected in the stock price, which is down 30% from its all-time highs and basically trading at the same levels it had 4 years ago. The other thing I like about the stock is that it pays a dividend. Now, yes, that dividend was cut in a cash-conserving measure as the pandemic hit earlier this year. At the current price of the stock, we're getting a dividend yield of about 3%, which is more than adequate considering where we are right now. Executives have told Wall Street analysts that they remain committed to a quarterly payout as well, and Raytheon has an investment-grade credit rating, and its cash flow remains nicely positive despite the stresses of the last 4 or 5 months. Now, if I can just briefly go through the technical analysis of the stock as well, as you see here, we have a company, a share price that is about 30%, as I mentioned, below the all-time highs that we saw back in February. The shares are also trading below this blue line. That's the 200-day moving average. Now, there's nothing magical or predictive necessarily about any of that. The main thing it just shows is that the share price is still recovering from the sharp plunge that it saw between February and March. It has not gone up to new all-time highs by any stretch of the imagination, which is yet another reason why I like it, because it shows this is one of those shares, one of those stocks, one of those industries, a sector which has yet to incorporate an eventual recovery of that particular sector as we move through COVID-19, as we move through the pandemic and look on beyond the point where the vaccines begin to come online. So in my view, these are the kinds of stocks that we need to begin to look at because they are still underpriced and they do not reflect yet the growth that is coming down the line in future quarters, again, with the vaccines and the presumed recovery from COVID-19. So if we look at the share price over a longer perspective, again, this is going back basically to the beginning of the decade. And you can see, the stock has had its ups and downs, but generally had a very nice upwardly moving profile. But it has had a very nice upwardly moving profile for many years. And I see nothing in this chart to tell me otherwise, especially when we pair it up with what the overall fundamental analysis shows us with the stock and the company being on track to earn nice profits for this year, profits over $2 for next year, and nearly $4 a share for 2022. None of that has been priced into the shares thus far. Overall, there's a lot to like about Raytheon Technologies, in my opinion. It's a play on the emerging drone economy, a play on advanced defense technology, and a premier supplier to the commercial and military aviation market. And the stock is at a price that's hard not to like, in my opinion. If you like what I'm talking about, make sure to subscribe to us here at the Wealth Press YouTube channel and to follow me on Twitter and on Facebook. I'm Jeff Yasteen.